There's two imbalances to look at. What's happening on the physical market, which is what he's referring to, and then what's happening on the financial markets. And what's happened in the financial markets is what's been moving prices. Essentially, you have a lot of investors, a lot of consumers. These are bona fide hedgers hedging the risk of Iran further out. That's put upward pressure on the back end of the oil forward curve. Now, the issue is we don't have producers coming in and selling right now, which has dragged this market higher despite a relatively balanced market on the physical side. So the real issue here is what happens to Iran. There's a lot of uncertainty right now. We don't have a clear picture on it.
When the Journal talks about this rally reigniting calls for 100, is that ridiculous?
Well, if you have a sustainable loss in Iran, 90 to 100 is a potential outcome here. But we don't know at this point what's going to happen to Iran. In fact, there are three issues that we're focused on right now. One, what are the waivers going to look like? We'll know that. We won't know until the sanctions go in effect on November 4th. The second thing we're watching is the ability for producers outside of Iran to respond. That was what the Russians said this morning, and we'll find out what the Saudis and others are willing to do. And then the third is we're waiting for producers to come in and sell that back in. I mean, you look at DEC 19, it's trading at 75.50, and that's a really rich price relative to their cost structure.
How much hangs on the question of whether Iran can continue to sell to the Europeans, these workarounds, which the Iran foreign minister as recently as, I think this weekend, said is in process?
Well, the key issue here is access to global payment systems. And if they label somebody a money launderer is how they get them outside of the global payment systems. And so when we think about those that are the most exposed, big international companies like Total would be the ones that would be most exposed to this. But if you start thinking about teapot refineries out in the middle of China, they don't need access to the global payment systems. So I think, again, it's not really clear who's going to really take this serious. And also the big issue really goes down to waivers.
To waivers. A lot of people come back, though, in terms of supply to Saudi Arabia, and there's an argument made that they really don't have that much excess capacity at this point. Do you agree?
That's what the market's pricing. In the very immediate term, it's constrained, but we've seen a sharp run-up in drilling in these key OPEC countries. You have new pipes next year coming online in the U.S. So the way I'd answer that question is very near term, yes. But you have the neutral zone in the Middle East, which is 300,000 barrels per day, but it's not going to be available for another 4 months. Russia's come out with several 100,000 barrels per day, but that needs to be redistributed. So very near term, there is a concern, and that's what the market is pricing on the back end. The way I like to think about it, the market is not pricing today's problem, it's pricing a potential problem tomorrow based around these capacity issues.
Which you think will resolve fairly quickly?
Well, we will understand more. We want to be long oil right now. We're not in the camp that it's going to 90 or 100, but we want to be long because we don't know. What if you do get the sustainable outage, then you go to 100? We will know on November 4th what the waivers are going to look like. We're going to know those issues, which is why we want to stay long until we get clarity. Once you have clarity on that, then we can answer those questions about how much of a serious upside you have due to these capacity issues.